So welcome back to my Vanguard portfolio update series. We're now in 2023, which means we can forget about the whole of the stock market and the economy for 2022, start afresh and just pretend none of it happened. Anyway, just before we jump into those numbers and have a look at my account live today as it stands, let's just have a quick review, kind of talking about the last 12 months and where the markets are just at the moment and give ourselves a good idea of maybe what we're heading into this new year of investing. I think the best analogy I can think of for last year was kind of like a big balloon, but it didn't just pop, it deflated very, very, very slowly and was pretty much a downward trend for the entire year. As you can see on screen now, when we look at the S&P 500, we're down around 20% for that last 12 months. Now 20% doesn't sound that bad, but it actually puts it in one of the worst ever years for the market. And I'm sure there's plenty of you out there who wish you only lost 20% last year, but we put that into perspective, that's actually one of the largest drops that the S&P 500 has ever seen. Now just put it up on the screen for you now, all of the different returns we've had per year for the S&P 500 going back a number of years, and you can see 2022 was a very bad year to be an investor. However, although the US is the biggest market in the world, why don't we have a look close to home just to see how the good old FTSE 100 did. I'll put this up on screen now. As you can see, the FTSE 100 actually held up, I guess you would say relatively well if we're honest. You've got just up about 1%, and also this doesn't take into account any dividends that were paid. And I think this kind of reflects some of the shift and some of the mentality that investors have seen this year as we've moved more from those big hyper growth stocks to the kind of more boring and value oriented stocks. The ones that actually generate those profits and real returns actually provide the money to give back dividends, for example, back to shareholders. Anyway, where do we begin? 2022 started off with the war in Europe. We've got the supply chain crisis. We had lockdowns in China, trade wars between the US and China as well. Lots of rhetoric around that. And then we've seen inflation run rampant all around the world from various stimulus packages from different governments and different central banks. Then the price of those big commodities like oil and gas and energy have slowly flowed and made their way into all the consumer products that we like to buy. Funny enough, speaking about those commodities and different things that have forced inflation to kind of run rampant through the whole world, the price of oil is now kind of back to where it was at the start of the year, which is quite interesting, but I'm sure lots of people from the UK will still be quite annoyed realizing that their energy bills haven't fallen that same level. Unfortunately, we're in a little bit of a different situation from the rest of the world, especially the likes of the US. We're a bit more secure when it comes to their energy supplies. And just going back to talking about those kind of hype stocks and growth stocks that we've seen kind of deflate over the past year and come back down to earth somewhat, wouldn't be a financial YouTuber if I didn't mention everyone's favorite stock, Tesla. Now, this stock has had a terrible year, and as you can see, even over the past couple of days, has kept falling after those Q4 delivery numbers come out. I think Tesla's been that perfect example that the retail investor's been heavily sucked into, expecting just to keep going on and up and up and up, always going to the moon, and every single year just going up in a straight line. The problem is that the stock market doesn't work like that, and although the fundamentals of the company might still remain strong, really, really important what you actually pay for a stock and try and get some sort of reasonable valuation, because it's very easy to get carried away. And unfortunately, and I hope that lots of retail investors have actually learned over the past couple of years, that actually it's not as easy as you think. You can't just buy a single stock and put all of your assets into one stock and just expect it to moon. And especially in a company or a stock which is heavily covered by the media, heavily covered by almost everyone on YouTube, and extremely well covered by different analysts. It's not exactly a small cap stock which is like some sort of hidden gem. It's very much out there in the public, so I'm not sure what kind of edge that investors are expecting to play. But anyway, it's going to be an interesting year ahead. Anyway, let's not spend too much more time on talking about last year. If you do want a bit of a roundup on that and some of the lessons I've learned and some of the lessons I think investors should have learned, I will pop up that video on screen now for you and you can go back and watch that one. Anyway, for now, let's jump on the laptop. Okay, so here we are in the Vanguard account at the moment on screen now. I'll start with my SIPP and then we'll talk about my stocks and shares ISA. As many regular viewers know, I'm a very simple person when it comes to investing, and especially when I talk about my pension, I like to keep things very simple because this is going to be a long-term investment. It's not something that I can touch or get access to for many years. It's going to be at least 20 years before we can actually touch this money. So we want to keep things nice and simple and really take time and let the kind of compounding effect do its work. As you can see, we're deep into the red. Now, bear in mind, this pension has been working for many years outside of Vanguard, so you might think this would be some terrible investment in the short term. But this pension's been brought together because it's a self-invested personal pension from different providers that I used to have from different places I used to work. So it had been growing for other years, but this has only been in Vanguard for just, I think, from around April or May time, but you can follow that with all of my portfolio updates where I moved everything across bit by bit and then just lump summed investing into the S&P 500 and a bit of the emerging markets too. Now, if you ever want to break down your performance and go into your Vanguard account, if you log in, go to the performance tab, you can then actually break it down by month to see how things have actually got on. And you can see only just a couple of months ago, back in October, we were sat there actually in the green, but we've seen the last couple of months, especially from the US stock market, be especially poor, taking those returns down to nearly negative 2,000. Now, from my perspective as a very long-term investor, I'm not really bothered about this. If anything, I think it's a great opportunity to keep investing now into this account to help this grow over many, many years. And just on that point of whether it's actually a good time to invest now, I did a video recently covering this, especially my beginners for investing video, which I did new for this 2023. And actually, there's never a bad time to start investing. But if anything, a better time, of course, will be away from those all-time highs in this dip or whatever we're seeing now. You're probably going to see slightly better returns in the early money that gets put in. Nobody knows what could happen. It could absolutely fall. But if anything, if you're starting now, not a bad place to be. The euphoria is slightly out of the market. We're kind of deflated or deflating. Who knows where we really are. But starting now is never going to be a bad time, especially if you're a long-term investor and dollar cost averaging like I do into long-term index funds ultimately. Just one more point and one more observation that I do bring up now and again. You'll see that I'm invested heavily into VUSA, which is an S&P 500 ETF. Now, the downside of the ETF on the Vanguard platform is that it doesn't automatically reinvest any dividends. So every quarter, every 3 months, you'll see a dividend hit your account. As you can see in the account at the moment, I've got £32 worth of cash. Now, unfortunately, the actual price of one share of VUSA, I think, is around 60 something pounds. But if I can go into that, and I'll put it up on screen for you if I can get that for you, which means I will have to wait until I've got 65 or however many pounds it costs to actually buy another share. One thing I could do, and I'd like your feedback on this actually as an interesting point, is probably the most equivalent mutual fund which would accumulate on the platform is that US equity fund that they have. And again, I'll put that one up on screen for you now. The benefit of that fund as well is that it doesn't just cover the S&P 500, it does cover a wider section of the US market as well. That could be a good benefit for you. You don't want to keep going into your account and manually reinvesting dividends every quarter, and you're not too bothered about that. That could be the way forward. Or the alternative is to not use Vanguard and use another platform like Trading 212, InvestEngine, and all the other brokers out there too, where you can get hold of VUAG. And I did a video on this one recently as well, talking about the best index funds. Check that one out. I'll leave that one in the description. So just a thought there. Potentially I could do that because for my emerging markets stock index funds, as you see on screen now, this one is an accumulation. So this isn't an ETF because I actually moved this over from Hargreaves Lansdown when I was moving my SIPP. So for the sake of a very small percentage difference in cost for that mutual fund, it potentially could be a good idea. But let me know your thoughts anyway. But that's where we stand at the moment. So lots more years to invest in this one anyway, hopefully, as long as I am able to live and survive that way. But hopefully we should be okay. Now, jumping over to my ISA on screen now, you will see that I'm a very simple man. I'm a simple investor, at least when it comes to my ISAs and my pensions. I do play around with other stocks and individual holdings, and you'll see them all in my portfolio updates. But when it comes to my long-term investments, I really do want to practice what I preach. Keep everything in low-cost index funds. Now, whether you want to use a global index fund, add in your own bonds, and do different parts of the world, that's completely up to you, whatever you feel comfortable with. This suits me for the time being. But I never rule out adding different things. The FTSE 250, the FTSE 100, different elements of maybe being able to pick and choose. And I may do that actually as I start another ISA, potentially on InvestEngine next year, but watch this space when that video comes out. Now again, on this one, as you can see, it's pretty much flat. It's only down £199, which to me just signals bye, 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 bye. Thank you very much. And the reason I say that and the reason I think about that is because, again, as a long-term investor, I've had to kind of learn, and you switch your brain around to the mentality that when you see red in your account, this is actually a positive thing for a long-term investor because you don't need that money now. It's always, always, always nice to see those big green numbers in the account. I think you're a genius. I've put money and I've timed the market. Look at me go, I'm up thousands of pounds. But then on the downside of that is your next investment, your next month's paycheck or your next couple of weeks paycheck goes into your account. You're then buying at those higher amounts. And while you should never stop doing that and always just keep investing from a long-term perspective if you can, if you have that money spare to invest, actually seeing it red is better because I'm going to get a lower cost basis. So for me, I'm absolutely fine with that. But I do appreciate and understand that actually it's really difficult to get your head around that mentality. And as long as you have conviction in what you're doing and and you have a plan and you don't need to access the money, which is another big thing, then that's the way I kind of look at things. Anyway, quickly breaking it down month by month, which you start from the bottom here, you can see actually I started this ISA toward the end of the amazing bull market in 2021, at least on the Vanguard side. Of course, I've been investing for a lot longer than that. This is just relatively new to the Vanguard platform itself. As you can see, lots and lots of green. Then, of course, things started happening. 2022 happens. You can again see those cumulative returns kind of turn down, turn negative. It was green for most of the year, but in the end, there was no Santa rally. He forgot about the stock market and just gave presents to good children instead, and didn't leave any for us naughty investors. So unfortunately, we are in the red. But again, not really bothered. So if you want to see everything combined in all its glory, here you have the number on screen now. It's £51,376.71. Most of that made up for my self-invested personal pension. And I think this next coming year and this next coming tax year is really going to be a time for us to figure out, rationalize our accounts, and our stocks and shares ISAs are going to become extremely important. I am at the moment thinking about all of my other portfolios outside of Vanguard, my Hargreaves Lansdown, my Lightyear, my free trade, all of these ones which sit outside of an ISA. I am seriously considering how I get that into an ISA as soon as possible. Potentially selling some holdings, just getting them into that tax protected account, which means that once they're in that ISA, they're forever protected. Even if I open up a platform like Trading 212 and use that ISA, I could still trade individual stocks just in case I have any big gains, or also get any dividends if those new tax rules come in place over the next couple of years. But watch this space. I'll keep you posted on that. I'll definitely be interested to see in the comment section if you're changing your strategy this year and next year as we see those capital gains and dividends allowances change. Because in the past, although I'm a huge advocate of using a stocks and shares ISA, and it's an essential account, in my opinion, for an investor, I wasn't necessarily too bothered about having some investments outside of it. Whereas now I'm really thinking I should get them inside an ISA as soon as possible, because rules can always change, so we may as well get things in sooner than later. At least from an investing perspective, if you're a long-term investor with many decades ahead of you, to me that does make sense. But again, let me know in the comment section below. Anyway, as always, thanks so much for watching. Drop me a like if you found the video useful, subscribe for many more. If you want to follow along any other portfolio updates, I always have the playlist up here, ka-ching, and you can go back and watch every single portfolio update for many, many months through all of my different accounts. Alternatively, if you are quite new to investing and you want to get yourself set up, don't forget I've got a brand new Investing for Beginners video that I just did ready for 2023, which hopefully should be a good year for us investors. But anyway, thanks so much for watching, and as always, happy investing.